mutual funds are holding the bond funds. So as the investors sell the US treasury bonds, the bond value reduces. So bond value reduces means the NAV of that particular mutual fund holding the bonds. So the hybrid funds or bond funds. So their NAV goes down means the investors lose money in that also. So this is to clarify that it is not that all the bond funds are so safe and the equity mutual funds are so risky. The risk of money losing in bond funds, bond mutual funds and hybrid funds are equally there. From this example, you now understand. So how to bring down the borrowing cost? There are two options. Let's explore that. One is lowering the interest rate. So if the Fed cuts the interest rate, so in India it is repo rate. So the rate at which the central bank lends money to various banks, and there is a delta on that interest rate, on the repo rate. Say 5% is the repo rate and 2% they add their returns. So 7% is the rate at which they lend to people like us. So that's how the bank make money, by borrowing money from the central bank and earning that 2% from us and eventually making profit. So if the interest rate is cut by the US Fed, the central bank of US, then what happens? With high inflation, they are further reducing the interest rate, means inflation further increases and bond holders are forced to sell the low yielding bonds. So bond value reduces, the bond yield increases, and hence the borrowing cost can't be reduced. So that option of reducing the interest rate is ruled out. Now let's come to increasing the interest rate. If not increasing the interest rate, at least keep the interest rate at the same level as of now. What happens in that case? The debt repayment, like I told, $1 trillion is the debt repayment for the $40 trillion debt held by the US. So that debt repayment increases. So even if you increase interest rate, even though the inflation is arrested, the debt burden of US further increases. So you should understand that this is where a situation where auto loans are having highest default in US. The home loans are also defaulting. Credit card bills are also getting defaults. The housing market is on to the verge of a major downturn and the stock market valuation are at its peak. So increasing the interest rate is never an option. The Federal Reserve is really in a big dilemma whether to increase the interest rate, which will break the economy, the US economy, and if to reduce the interest rate, which will break the bond market. And also what happens to the investors as the bond yields are going so high? The so-called foreign institutional investors, they are going back to US and investing in the bonds because high yields of bond, risk-free return. They think if they are getting a higher bond, why they will hold stocks which is hardly giving 1 to 2% dividend yield. So they are exiting the stocks from various emerging countries and going back to investing in bonds of US. This is as far as the US institutions are concerned, the foreign institutional investors so called.